Hi everyone, we are from Group 4 and my group mates includes Darren, Joshua, KV, Lo-Ling, Roderick and myself, Chloe. Today we'll be presenting on Decentralized Finance, also known as DeFi. We'll be discussing on the introduction, timeline, benefits, application and challenges of DeFi, and lastly, the future outlook of it. What is DeFi? DeFi provides financial services on public blockchains, and the services it provides is similar to traditional banks. Some examples of the services includes borrowing, lending, insurance, trade derivative, trade assets, etc. It is operating in an unregulated and decentralized system, which solves the trusted third-party issues and provide fast and seamless transaction. This could be achieved via blockchain, which removes the traditional intermediaries and trust mechanisms. The attractiveness of DeFi had gained popularity, which increases the trading volumes. DeFi was reported to be capturing a size of $72 billion in February last year and proliferated to $170 billion in November. However, the Ukraine and Russia ongoing conflict and the anticipations of rising interest rates has resulted in additional headwinds for cryptocurrency market. Recently, DeFi sector has been trending higher to 120 billion since its new low this year. The market cap was close to 150 billion as of 29 March. The current top 3 highest traded DeFi tokens are AVAX, Luna, WBTC.
So how did DeFi start and become what it is today? The seed of DeFi was first sowed with the creation of Bitcoin by Satoshi Nakamoto in 2009, laying down the foundation for a new innovative peer-to-peer financial services by introducing the blockchain to the world. In 2013, inspired by the limitations of Bitcoin, Vitalik Buterin, the co-founder of Ethereum, announced the Ethereum project white paper titled A Next Generation Smart Contract and Decentralized Application Platform. The following year of 2014, MakerDAO is founded by Rune Christensen and a few others that allows the creation of a decentralized stablecoin called DAI. MakerDAO would eventually become the first DAO to launch on the Ethereum blockchain. In the next year, 2015, Ethereum was finally launched. It uses a theory-complete programming language called Solidity that enables developers to write and deploy smart contracts that form the dApps hosted on the Ethereum network. In 2017, single collateral DAI is launched on the Ethereum mainnet. Users Maker protocol are able to generate DAI tokens against ETH collateral. It provides proof of concept for the idea of a decentralized stablecoin. Uniswap, a decentralized exchange, was created by Hayden Adam in 2018. It introduced the concept of automated money maker model for DEX in the crypto space. Uniswap enabled trading via the introductions of liquidity pools in the protocol's smart contracts. It also utilizes algorithm instead of order book to set the trading price. Then came the summer of 2020, or what is better known as DeFi summer. Due to the COVID-19 pandemic and the loss of trust in the traditional financial system, DeFi applications from lending and borrowing to yield farming and insurance sprung up. Instruments that are usually only offered by traditional finance were developed during lockdown. Some prominent names you might recognize are Aave, Curve, Orion, and Centrifuge.
Benefits of DeFi. Permissionless, there's no central authority required, as there is open and permissionless accessibility where anyone can join, and it helps to serve unbanked and underbanked people. Next, DeFi technologies and blockchain systems are immutable and irreversible, which could be achieved using cryptography and consensus algorithm like proof of work, so no one could make any changes to the blockchain network. Thirdly, transparency. All information of activities that were captured on blockchain network will be reflected in distributed ledger. The adoptions of cryptography would help validate the authenticity of the information in the document. Hence, it avoids possible financial scams or harmful business practices. Fourth, lower costs. With adoptions of smart contracts on the blockchain, it removes trusted third-party and simplify complex transactions, hence lower friction and cost in financial transactions. Lastly, the high adoptions of DeFi recently has also been related to the rise of yield farming, which allows investors to do deposit and lending but provide interest rate that is multiple times higher than traditional banks. Thus, it resulted in higher demand and higher yield.
Thanks, Chloe. Now that we understand the benefits that DeFi can bring, let's look at more specific applications of DeFi. First, we have the borrow lending protocols where users borrow and lend crypto assets without any trusted third party by enabling peer-to-peer lending between network participants. Loans are often over-collateralized because of a lack of credit scoring and KYC system. These loans will also be disbursed through self-regulating smart contracts. The top 3 players in the space are MakerDAO, Aave, and Compound, with MakerDAO being the current leader in the space. Borrow lending protocols in DeFi not only allow users to borrow and lend much quicker than traditional banks, They are also permissionless, fully transparent, and non-custodial. However, DeFi users take on risks such as unintended liquidations of their collateral during volatile periods. Smart contract exploits have also been a key risk to account for, with a few recent multi-million-dollar losses as a result of smart contract bugs in some borrow lending protocols. Next up, we have DeFi insurance protocols. DeFi insurance refers to insuring yourself or buying coverage against losses caused by events in the DeFi industry. Suppose you lend some crypto assets on the previously discussed borrow lending pools like Aave, and you are aware that you might lose your capital if this protocol gets hacked. You might want to insure yourself against this risk so that you can get paid out from the capital pool in the case of such events. Some of the DeFi insurance events that are covered are centralized exchange hacks, smart contract failures, or stablecoin price defects. Anyone with crypto assets can also use these capital pools to generate sustainable yield by receiving a portion of the insurance premiums as long as they take on the risk of a payout happening. A DAO structure is often used in these protocols to determine if a claim is verified and is entitled to a payout. The current two biggest insurance protocols are Nexus Mutual with 400 million USD in active covers, as well as InsureAce, which has 314 million USD in active covers.
Thanks, Duoling. Next up, decentralized exchanges, also known as DEXs, and automated market makers, AMM. Decentralized exchanges are cryptocurrency exchanges that allow for peer-to-peer transactions in a secure and transparent way without the need for an intermediary. Unlike traditional exchanges and centralized exchanges that are non-custodial and permissionless, users are also able to act as liquidity providers and in turn earn fees from the volume traded on these AMM pools. Some leading DEXs in the space are TraderJoe, PancakeSwap, and Uniswap. However, AMMs face a large issue where liquidity providers face impermanent loss when the asset prices diverge. Price slippage is also high when there's too little liquidity in the pool or when a large order is executed. Since orders made on an AMM are broadcasted to the blockchain, front-runner bots are also known to exploit users, which is also known as a sandwich attack. Next up, derivatives. Three such types of derivatives in DeFi now are decentralized option vaults, aka DOVs, synthetic assets, also known as SIMs, and decentralized perpetuals. DOVs provide users a way to earn sustainable and organic yield using option strategies. Investors simply stake their crypto assets inside these vaults and automatically deploys the option strategy. Ribbon Finance is a leading DOV with a TVL, total value locked, of $320 million US. SIMs are tokenized derivatives that mimic the value of another asset. This allows users to gain exposure to assets that are not on a blockchain, such as your fiat currencies, stocks, and commodities. Synthetics is the leader of this space with a market cap of $890 million US. Decentralized perpetuals allow users to trade on margin through DEXs, and these are permissionless and non-custodial as well. These perpetuals allow traders to hold leveraged positions indefinitely without the need to roll over their positions. Decentralized perps are led by DYDX with market cap of $432 million US.
Moving on to our next part, stablecoins seek to maintain price stability as they are pegged to reserve assets such as a fiat currency or commodity or even other cryptocurrencies. Stablecoins stand to enjoy the benefits of being a cryptocurrency without the associated extreme volatility due to its characteristics. They are intended to solve volatility issues that arguably hold back the potential adoption of cryptocurrencies for everyday payment purposes. Stablecoins can be categorized into three different types. Firstly, Theta is an example of a fiat collateralized cryptocurrency that is backed to an equivalent amount of US dollars. DAI is an example of a crypto collateralized stablecoin, and it aims to keep its value close to $1 as possible through an automated system of smart contracts on the Ethereum blockchain. And lastly, we have non-collateralized stablecoins. Ampleforth is such an example, and it adjusts its supply of AMPL using a software algorithm to maintain price parity with the US dollar. Traditional finance institutions are finally picking up the pace and treating the DeFi revolution with more importance and seriousness, and they are switching their strategical focus. As you can see on the right side of the screen, these are just some examples of headlines of banks, central banks, or even individuals putting in more importance and seriousness into the DeFi revolution. The revolution is a worldwide phenomenon, rocking the entire landscape, as you can see, from individuals to SMEs to banks, exchanges, and even central bank and regulators are paying more attention and resources to DeFi. The message is clear: adopt or risk being left behind.
Thank you, Josh. So moving on, DeFi faces several challenges in its development, and the biggest issue of all is the blockchain trilemma. This trilemma refers to the challenges that blockchain developers face in creating a blockchain that's decentralized, scalable, and secure. The limitations of a decentralized and distributed network means that there must be a trade-off between these three core concepts. For instance, the Solana network focuses on security and scalability, while the Ardor network focuses on decentralization and scalability. However, most DeFi services are on the Ethereum network, which prioritizes security and decentralization, meaning that scalability is limited. Another issue is the vulnerability of smart contracts. Since DeFi products are built upon smart contracts dealing with user funds, anyone who's able to exploit weaknesses in the contract can potentially steal these funds. This makes these contracts an attractive target for hackers, and given that smart contract code is stored transparently on the blockchain, it's even easier for attackers to identify vulnerabilities and take advantage of them. And lastly, most DeFi platforms have weak know your customer and anti-money laundering processes in place, making DeFi vulnerable to illicit activity. Consequently, regulators may have trouble accepting DeFi as an official financial space, which will inhibit the development of DeFi. To conclude, while DeFi has gained much momentum in recent years, the adoption in the crypto space is still low, with less than 5% of all crypto assets being used as collateral in DeFi. DeFi is also still largely limited to basic forms of borrowing and lending. This leaves DeFi with massive room for expansion. However, efforts to bridge centralized finance into DeFi has been inhibited by issues such as the hostile regulatory environment, low capital efficiency, and management of counterparty risks. Thus, it's likely the emerging concept of MetaFi will be the main growth driver of DeFi. MetaFi refers to protocol services and products that allow for the intricate financial interactions between non-fungible tokens and fungible tokens or their derivatives. It brings the core concepts of DeFi, composability, unstoppability, and openness onto the metaverse. The MetaFi ecosystem will thus act as the financial infrastructure layer of the metaverse and unlock the value from the metaverse, allowing for the financial inclusion of creators, gamers, and digital natives who participate in this open virtual environment. And with that, we have come to the end of our presentation. We hope you enjoyed it, and thank you for your time.